There we go. Committee will come to order. How's that? Without objection, the chair is authorized to declare recess of the committee at any time. This hearing is entitled Legislative Proposals for a More Efficient Federal Regulatory Regime, Part 2. Before we begin, I'd like to thank the witnesses for appearing today. We appreciate your participation. Look forward to a very productive discussion. Thank you so much for taking time out of your busy schedules to be with us. I now recognize myself for 5 minutes for the purposes of delivering an opening statement. A common complaint heard throughout the financial services industry is that the regulatory pendulum has swung too far. Rules and regulations are driving financial institutions to merge, exit entire lines of businesses, and discontinue services to their customers. We see it every day and hear about it not only from institutions but also from their customers, many of whom have experienced increased difficulty gaining access to credit and other financial products. Today we'll consider 5 bills that seek to change the status quo. We will review legislation written by the gentleman from Florida, Mr. Posey, to amend the problematic points and fees rule that has frozen some buyers out of the housing market. We'll also examine legislation offered by the gentleman from Indiana, Mr. Hollingsworth, which highlights the issue that U.S. regulators are consistently going well beyond and above international standards promulgated elsewhere around the world. The gentleman from Wisconsin, Mr. Duffy, has introduced legislation to ensure that the CFPB stays out of the business of insurance. Dodd-Frank very clearly limited CFPB's authority in the area of insurance, yet the Bureau has demonstrated a keen interest in insurance products. This legislation would guard against the mission creep at CFPB. We will examine a second bill introduced by Mr. Posey, which would repeal the National Credit Union Administration's risk-based capital rule. This is a rule that generated concern from more than 300 members of Congress and would have a dramatic impact on the ability of credit unions across Missouri and the state to serve their members. Finally, the subcommittee will discuss a draft legislation offered by the gentleman from Georgia, Mr. Loudermilk, which would amend the Economic Growth and Regulatory Paperwork Reduction Act to require federal banking agencies to conduct an annual review of all regulations and determine how those regulations impact the financial safety and soundness of an individual insured depository institution. I don't think anyone in this room questions the importance of meaningful and thoughtful regulation of financial companies. But for too long, Washington bureaucrats have used and in many cases abused their authorities to overreach and create a regulatory regime that is unnecessarily punitive. This subcommittee will continue its mission to restore sanity to the regulatory landscape, ensuring that those in the financial services industry are held accountable while still having the ability to serve their customers. It is possible to have a regulatory regime that protects the American people and financial system without curtailing customer choice. The legislation we discussed today helps to foster that smarter, more reasonable environment. I want to thank Mr. Posey, Mr. Hollingsworth, Mr. Duffy, and Mr. Loudermilk for their good work on these bills. We have a distinguished panel with us today. We'll look forward to hearing your thoughts on these important issues and proposals. The chair now recognizes the other gentleman from Missouri, Mr. Clay, ranking member of the subcommittee, for 5 minutes for the purpose of an opening statement.
Thank you, Mr. Chairman, for conducting this hearing. And in the interest of time, I will forego a opening statement, and I'd like to hear from the witnesses. I yield back.
Thank you, gentlemen. I hope that's an endorsement of my previous open statement.
We shall see.
Okay. Well, I tried. Anyway, today we welcome a great panel, I believe, and we hope we'll anticipate your testimony. Mr. Anthony Cimino, Senior Vice President and Head of Government Affairs for the Financial Services Roundtable. Mr. Brian Ducharme, President and CEO of MIT Federal Credit Union on behalf of the National Association of Federal Credit Unions. Mr. Christopher George, Chairman-elect, the Missouri Mortgage Bankers Association, and Mr. Marcus Stanley, Policy Director, Americans for Financial Reform. Each of you will be recognized for 5 minutes to give an oral presentation or testimony. Without objection, each of your written statements will be made part of the record. Lighting system is green means go, yellow means you have a minute to sort of wrap up and finish your points, and we have the same timing mechanism up here. When red hits, that's hopefully you can stop it and withdraw and move on. So with that, Mr. Cimino, you are recognized for 5 minutes.
Chairman Luke DeMeyer, Ranking Member Clay, members of the committee, thank you for the opportunity to testify today. My name is Anthony Cimino. I'm with the Financial Services Roundtable. My comments today will focus on H.R. 3179, the Transparency and Accountability for Business Standards Act, and H.R. 3746, the Business of Insurance Regulatory Reform Act. First, let me say that FSR applauds your efforts to assess and modernize the regulatory financial system. To that end, FSR supports H.R. 3179, the TABS Act. This legislation would require federal banking agencies to perform an analysis and provide a rationale when promulgating standards that are more stringent than the related international standards. In implementing the most recent agreement, Basel III, U.S. banking regulators have in some cases pursued a policy of quote-unquote gold plating or a heightened prudential scrutiny for U.S. companies. I would like to touch on 3 areas in particular. The first example is the GSIB surcharge. Basel III imposes a capital surcharge on global systemically important banks. U.S. regulators adopted this GSIB surcharge, so-called Model 1. But in addition to that, U.S. regulators also adopted an additional requirement, Method 2, a more prescriptive surcharge. In some cases, it has forced an extra 2% capital charge, which according to one estimate, cost $52 billion in capital and has reduced lending capacity of the U.S. financial system by $287 billion. The second example is the enhanced supplemental leverage ratio. In conjunction with international agreements, U.S. banking regulators imposed a 3% supplemental leverage ratio requirement on certain bank holding companies. They did then, however, apply an enhanced SLR that requires GSIBs to meet a 5% SLR requirement at the holding company level and a 6% enhanced SLR at the bank level. That 6% is double the international standard. The third area I'd like to point out to you all deals with the liquidity coverage ratio, which requires banks to hold enough high-quality liquid assets to withstand a severe 30-day stress scenario. In setting the LCR, however, U.S. agencies deviated from the internationally agreed-to methodology, specifically for inputs on cash outflow assumptions and maturity assumptions for options. This had led to different outcomes for the calculation, but estimates indicate that a 1% change in the calculation may increase bank lending by approximately $17 billion. These are just 3 examples where the U.S. has deviated from international standards. It's important to note that H.R. 3179 would not, however, weaken standards or repropose rules. The legislation merely establishes a transparent mechanism to assess, impact, and provide a rationale for any delta between the U.S. and the international standards. We believe that this understanding and related decisions can bolster U.S. competitiveness and drive economic growth. Shifting gears, I'd like to point out that FSR supports H.R. 3746, the Business of Insurance Regulatory Reform Act. Under McCarran-Ferguson, Congress granted states the authority to regulate the business of insurance. Title 10 of the Dodd-Frank Act reflected that as well. The law created the CFPB, but exempted the business of insurance from its authority. Despite this, the CFPB has at times expanded its scope to include the business of insurance. For example, in 2016, as part of a request for information for certain loans and ancillary products, the CFPB requested information on credit insurance, which is an insurance product regulated by the states. A second example comes through the CFPB's proposed rule on arbitration agreements. The proposal sought to apply the arbitration rule to policy loans made by life insurance policy providers. These policy loans are loans secured by the cash surrender value of the related policy. The life insurance policy providers are not creditors under the COA Act, and the products should not be subject to CFPB oversight. These are just 2 examples of that mission creep. In each of these cases, state regulators and interested parties clarified the important role of state insurance regulators. H.R. 3746 seeks to address this ambiguity and potential mission creep by reiterating and clarifying that insurance regulation with respect to consumer products and services remain the purview of state insurance regulators. This legislation will create greater certainty, regulatory stability, and help the marketplace and consumers. The Financial Services Roundtable again commends the committee for its leadership and desire to assess and optimize the regulatory system. We urge the committee to advance these bills and look forward to working with them on this. I would also like to commend the staff on both sides of the aisle for their hard work on all of these issues and continue to work with them as we go forward. With that, Mr. Chairman, thank you. I'm happy to answer any questions.
Thank you. With that, we appreciate your comments. With that, we recognize Mr. Ducharme for 5 minutes to give us a presentation. You're recognized.
Thank you, Mr. Chairman. Good afternoon, Chairman Lukemeyer, Ranking Member Clay, and members of the subcommittee. Thank you for the invitation to appear before you today. My name is Brian Ducharme, and I am the President, CEO of MIT Federal Credit Union headquarters in Cambridge, Massachusetts. My written testimony outlines a series of tenets that NAFQ believes are necessary for credit unions to thrive. We hope you'll consider these as you work to establish a more efficient federal financial regulatory regime. I would like to focus my comments on one key piece of legislation before the committee, the Common Sense Credit Union Capital Relief Act of 2017, introduced by Representative Posey. This legislation would stop NCUA's risk-based capital rule, RBC, from taking effect on January 1st, 2019. NAFCU believes this rule is ill-conceived and its current form will have a negative impact on the credit union industry. The process that NCUA used to establish this rule was very problematic and took nearly 2 years to complete, with the final rule being approved by a 2-to-1 vote in October of 2015, with current NCUA Board Chairman Mark McWaters dissenting in that vote. The health of the credit union industry has only continued to improve since the rule was adopted, with over 95% of the industry's assets held in Camel 1 and 2 credit unions, mitigating the need for this rule. We thank Chairman McWaters for his leadership in recognizing that the current rule is problematic and needs reform. However, the political uncertainty due to the vacancies on the NCUA board is impacting the agency's ability to make timely changes. With the rules set to take effect a year from now, credit unions must soon begin their review of their portfolios to come into compliance. This could lead to some institutions curtailing lending in 2018 as they seek to maintain their capital level and capital cushion. Not only is compliance with this rule problematic for credit unions, it also ties up NCUA resources as it prepares to implement a flawed rule. NAFCU believes that Congress should step in and stop this rule from taking effect. NAFCU analysis has found that over 400 credit unions will see a combined $1.4 billion decline in their capital cushion when the rule becomes effective. Over 40 credit unions will face a downgrade in their capital category, and MITFCU is one of those credit unions facing a downgrade. Our members look to us for many of their financial services, including a wide range of mortgage services. With young adult members, we have been an important option for them as they become first-time home buyers. MITFCU also provides advisory services relating to college planning, as well as federal and private student loans. Today, MITFCU helps individuals make important decisions and provides funding in many cases when others will not. Our products have been prudently managed. However, under the new RBC rule, MITFCU's ability to continue to serve our members with these products will be constrained. The new RBC rule has also forced MITFCU to reconsider offering business services as well. Regardless of how prudently we have managed these programs, we may have to stop providing them, which is not in the best interest of our members. And many other credit unions will also find themselves in this very same situation. Finally, it's important to remember that credit unions, unlike other financial institutions, are locked into a net worth ratio system that does not evolve in the face of changing market conditions. A more flexible RBC framework could counterbalance the immutable requirements of credit union PCA laws. In conclusion, one of the biggest impending burdens on the credit union industry is the implementation of NCUA's risk-based capital rule. While NAFCU supports a true risk-based capital system for credit unions, the current rule, set to take in effect January 1st, 2019, does not provide this and is fundamentally flawed. The Common Sense Credit Union Capital Relief Act of 2017 is needed, and we would urge the committee to support this timely legislation. Chairman, thank you for the opportunity to appear before you today, and I welcome any questions that you or the committee may have.
Thank you. Mr. George, you're recognized for 5 minutes.
Chairman Lukemeyer, Ranking Member Clay, and members of the subcommittee, I appreciate the opportunity to testify this afternoon on behalf of the Mortgage Bankers Association. My name is Chris George, and I am the founder, president, and chief executive officer at CMG Financial, a privately held mortgage bank in San Ramon, California. I also currently hold the position of chairman-elect at the MBA, and I have previously served as the chairman of the California Mortgage Bankers Association. As a 3-decade veteran in the mortgage industry, I am pleased to share my views today on H.R. 2570, the Mortgage Fairness Act, and the Comprehensive Regulatory Review Act. MBA supports both bills and believes they offer practical solutions to improve the efficiency of mortgage market regulations. One of the most significant features of the Dodd-Frank Act was the requirement that lenders, during the underwriting process, carefully demonstrate a mortgage borrower's ability to repay their loan. And while the qualified mortgage standard that was developed by the CFPB was not meant to limit mortgage originations to only loans that meet this standard, the significant potential liability and litigation expense for violations of the ability to repay rule have directed the vast majority of the market towards QM loans that provide safe harbor from potential litigation. As the ATR rule and QM standard have been implemented, MBA has consistently maintained the view that mortgage originated with the same interest rate and other product features should be treated equally from a regulatory perspective, regardless of the originator's business model. H.R. 2570 aims to improve a provision of the ATR rule and QM standard that generates unequal treatment of loans originated by mortgage brokers. The ATR rule and QM standard includes fees paid by wholesale lenders to a mortgage broker and the calculation of points and fees, which is used to determine whether a loan qualifies for the QM safe harbor. However, fees paid by a wholesale lender to a mortgage broker are already reflected in the interest rate offered to the consumer, resulting in a double counting of those fees. Because of this double counting, loans originated through mortgage brokers are more likely to exceed the maximum allowable points and fees under the ATR rule and the QM standard. This treatment results in some loans originated by mortgage brokers failing to qualify for the QM safe harbor, while the exact same loans would have qualified if originated through a different channel. H.R. 2570 would eliminate this double counting and level the playing field for mortgage brokers, increasing competition in the lending market. We think this would ultimately benefit consumers, in particular low to moderate income consumers, by giving them greater choice when they go to shop for a loan and thus potentially lowering their borrowing cost. MBA supports H.R. 2570 and urges the committee to advance this common sense provision to ensure that otherwise similar loans are not treated differently due simply to their origination channel. MBA also supports the Comprehensive Regulatory Review Act, which amends the Economic Growth and Regulatory Paperwork Reduction Act. This legislation will clarify the EGRIPA review process and eliminate ambiguity to ensure the Federal Financial Institutions Examination Council undertakes the timely review and elimination of any unnecessary regulations. EGRIPA is an oversight mechanism designed to ensure that regulations are reviewed and evaluated in light of changes in the market or the interlocking federal regulatory structure. The proposed legislation seeks to improve the EGRIPA regime to better reflect significant structural changes to the federal regulatory landscape that have occurred since its adoption in 1996. This legislation accomplishes its goal by increasing the frequency and expanding the breadth of reviews, and also by incorporating additional regulators in the process. The proposed legislation requires comprehensive review every 5 years rather than the current once-per-decade requirement. A shorter interval between reviews will prompt regulators to move more quickly to review the burden of outdated regulations and identify those that are otherwise unnecessary. Given the fast pace of the technological innovation in today's market, a more frequent regulatory review cycle is critical in ensuring that regulators keep pace with the market and do not stifle innovation. If this legislation is codified, the regulator's responsibility would no longer end with just an inventory of unnecessary regulations, but with the elimination of unnecessary regulations. In addition, each regulation must be tailored in a manner that limits its regulatory compliance impact, cost, and liability risk. In this way, the proposal provides actual regulatory relief. MBA sees this proposed legislation as having a positive impact on the efficiency of the mortgage market regulations. MBA urges the committee to pass this bill to ensure that the consumer finance regulatory regime is appropriately tailored to accommodate market changes and technological innovation. Thank you again for the opportunity to testify today. I look forward to any questions you have.
Thank you, Mr. George. Dr. Stanley, you're recognized for 5 minutes.
Chairman Luetkemeyer, Ranking Member Clay, and members of the subcommittee, thank you for the opportunity to testify before you today on behalf of Americans for Financial Reform. AFR was created as a response to the disastrous financial crisis of 2008. That crisis caused 9 million workers to lose their jobs, 7 million families to lose their homes, and the nation to lose over $10 trillion in economic wealth. A key lesson learned in the financial crisis was the importance of strong regulatory protections in protecting consumers and the economy. Contrary to the claims of some, the financial industry is alive and well under Dodd-Frank. Since Dodd-Frank was passed, the financial sector has grown more quickly than other industries. In 2016, banking industry revenues rose to record levels. The fraction of community banks showing a profit increased from 79% in 2010, the year Dodd-Frank was passed, to 96% in 2016. Another metric of the health of the banking sector, the growth rate of bank commercial lending, has also exceeded historical averages since the passage of Dodd-Frank. In light of the extraordinary damage created by the 2008 financial crisis and the lack of evidence for an economically harmful effect of post-crisis regulations, it is very disappointing that the bills under consideration by the subcommittee today would uniformly lower regulatory protections for consumers and the economy. I will now briefly discuss each bill. Given the time limitations in my oral testimony, I urge interested parties to consult my written testimony for additional detail. H.R. 2570 would make it easier for lenders to steer homeowners into high-cost, potentially abusive loans on certain mortgages, notably home equity lines of credit. It would exempt yield spread premiums from tests used to determine whether a loan counted as a high-cost mortgage loan. These premiums often act as what are effectively kickbacks to the mortgage broker from the lender in exchange for an increased interest rate, a pernicious form of incentive payment that has been shown to contribute to steering, discrimination, and lending without regard to ability to repay. H.R. 3179 seeks to restrict federal banking agencies from issuing regulations more stringent than those laid out by international regulatory bodies. This bill would be a bad idea at any time, but it seems particularly misplaced today when many are claiming to advance an America First agenda in economic policy. H.R. 3179 could instead be described as an America Last bill, as its effect would be to reduce our ability to protect the American economy against the negative effect of poor decisions made by international bodies. If international rules were conceived of as dictating to member countries the strongest level of safety that could be required, this would result in imposing on each country the lowest common denominator acceptable to the more than 24 nations that are members of the Basel Committee on Banking Supervision. This would be a dangerous limitation on the ability of the United States to address risks of financial instability. This risk is particularly salient today, given the weaknesses in the European banking system. The weakness in the European banking system in practice means that Basel rules can be deeply influenced by the desire of European regulators to avoid placing stress on very weak and, in some cases, perhaps even insolvent banks. Subordinating U.S. bank regulations to what is attainable in a Basel consensus would be an extremely dangerous move. H.R. 3746 amends the Dodd-Frank Act in a manner that would significantly narrow and call into question the Consumer Financial Protection Bureau's authority to regulate entities regulate insurance entities, even if these entities were engaged in consumer financial activities that would normally be regulated by the CFPB. If H.R. 3746 were passed, it would significantly limit the CFPB's ability to investigate and enforce against consumer abuses in the many financial markets that involve both lending and insurance sales. There are numerous products and activities that span the insurance credit divide in this way. In my written testimony, there is a detailed example of the way the limitations in H.R. 3746 would have damaged the CFPB's ability to investigate and punish the Wells Fargo scheme to sell unnecessary insurance to its auto credit customers. Finally, the Comprehensive Regulatory Review Act would modify AGRIPA. Currently, the AGRIPA regulatory requirement is simple, direct, and clear. The statute requires regulators to review regulations and eliminate unnecessary regulations at least once every 10 years. The language inserted into AGRIPA by the Act would significantly slant regulatory consideration away from a true comparison of the costs and benefits of regulation and toward an attempt to minimize costs for regulated entities without considering benefits to the public. In addition, the change in the minimum required review cycle from 10 years to 5 years is also inappropriate, as the compliance costs of new regulations are front-loaded, while benefits to the public are weighted toward later periods. Thank you, and I'm happy to answer questions.
Thank you, Dr. Stanley. One bit of housekeeping here. We have a couple of members of the Financial Services Committee that are not members of this committee that would like to participate. So without objection, the gentleman from Wisconsin, Mr. Duffy, and the gentleman from Indiana, Mr. Hollingsworth, are permitted to participate in today's subcommittee hearing. And while not members of the subcommittee, Mr. Duffy and Mr. Hollingsworth are members of the full committee and we appreciate their participation today. They are not present in the room at the moment, but I understand they are coming. So thank you for that. I now recognize myself for 5 minutes. And because we've got a number of the sponsors of the bills here in committee today, I'm going to keep my questions pretty short so we have more time to let them talk about their own bills. So I'll be very brief. Dr. Stanley, I've got a question for you with regards to your testimony. Over the last several years, the regulators have changed the way they regulate from being a group that is in general. And these bills are here to try and solve a problem, I think, that's occurred over the last several years. Well, they've taken this attitude that you're guilty until proven innocent, that you are doing something wrong until you can prove that you're not doing something wrong, that they're playing a game of gotcha. They want to be punitive to almost every action. They're not willing to be sitting there, willing to listen to the institution and say, hey, you know, we didn't understand the rule or regulation. Can you explain it to us so we can get it right? And instead, they slap you with a fine and off they go. Do you think that's the way to do business?
I guess all I can say is that in our involvement in the regulatory process, we've seen very extensive comments filed and considered by the regulators. We've seen numerous exemptions put into regulations, de minimis exemptions. You can see that in the CFPB. Smaller banks, in many cases, were exempted from various rules, and we've seen very large. If you simply look at the regulators' calendars, there are many, many more meetings with regulated banks and regulated entities than with public interest groups. So I think we've seen that effort by the regulators to reach out.
I respectfully disagree. I think the reason for these bills today are that there are concerns that have been raised by these various institutions that are represented on the panel today, that in many cases, whether it's Dodd-Frank or some other banking regulations, have gone so far as that they do not. The cost benefit of the rule and regulation is such that it does more harm than good. Mr. Cimino, I think you mentioned in some of your testimony here with regards to the impact of pricing and availability of credit, because I don't think that there is a cost-benefit analysis done. Would you like to elaborate on it just a little bit?
Yeah, I think when we approach things, we're always trying to figure out how to optimize the regulatory framework. How do we match a safety and soundness regulatory framework to address the risks in the system appropriately while optimizing how the financial services sector can invest in the economy, can invest in consumers and in businesses. And when you look at some of these regulations, especially when we're talking about one of the bills before us today, the TABS Act, the delta between international and U.S. clearly indicates that there should be an assessment as to, is this the right regulatory approach? Because in some cases, we're seeing a lot of capital be held on the sidelines that could be injected in the economy through lending, that could be helping to grow that economic opportunity out there. Happy to talk about any more of those details, but go ahead.
Thank you very much. I'm going to stop my questioning here, and we'll recognize the ranking member, the other gentleman from Missouri, Mr. Clay.
Thank you, Mr. Chairman. Dr. Stanley, with respect to H.R. 2570, can you discuss how yield spread premium payments operate and how leaving them out of the Consumer Bureau's points and fees calculations for mortgage loans could potentially result in borrowers' harm?
Yes, a yield spread premium is what yield spread premiums do is they take what would otherwise be an upfront fee paid by the borrower and convert it into an increase in the interest rate that the borrower would have to pay over the life of the loan. And this can considerably increase costs to the borrower. For example, over a 30-year, $300,000 loan, a percentage point increase, which would probably be too small to really be noticed by the borrower, would increase costs by something like $16,000 over the life of the loan. And in many cases, what we saw prior to the financial crisis was that part of those financial benefits from the yield spread premium were given to the broker in order to steer the borrower into that higher cost loan. And that was very harmful. I cite research in my testimony showing that that was very harmful prior to the financial crisis. And by limiting the upfront pointed fees, including the yield spread premiums that can be included in a mortgage, the CFPB has really prevented these kinds of abuses, that if these fees are put in, a mortgage would be classified as a high-cost mortgage.
And so over time, depending on what the interest rate is and how that's calculated, then that means people either pay more or less over 30 years for a mortgage.
Yeah, they could pay considerably more, and especially if they're steered into a product which would be a higher interest rate than what they would qualify for, higher than the minimum interest rate that they would qualify for. They could pay tens of thousands of dollars more. And
those interest rates are set based on credit ratings and credit history, and so I guess, and sometimes other factors are taken into consideration, such as race. Am I correct?
Yes, they were minority communities, communities of color were targeted for predatory lending prior to the financial crisis and paid a very heavy cost in terms of loss of equity in their homes.
So the people with the least means paid more. Wow.
That's right.
Oh, I see. Let me ask you about H.R. 3179. Would you discuss for the committee why this legislation may be the wrong approach for this country? Doesn't it make it harder for our regulators to implement strong capital requirements for our largest banks to better protect American taxpayers and the economy?
That's exactly right. I mean, what we've seen is that, as I said, the Basel Committee has 24 different countries, and it's got to reach an agreement on the safety standards for banks. And I know everyone in this room is familiar with the difficulty of reaching agreement when you've got dozens of different people on a committee. And a lot of those countries have very weak banks, much weaker than the United States. And there's a lot of pressure toward a lowest common denominator, toward low safety standards for U.S. banks. And I just wanted to respond to what was said by Mr. Cimino about the costs and benefits of these U.S. rules. The Federal Reserve did an extensive study just this year of the costs and benefits of our bank capital rules, and it found out that the U.S. bank capital rules were well justified in terms of protecting the economy and the public, whereas the bank capital minimums laid out by the Basel Committee were too low.
Do you find it strange that a cost-benefit analysis is required only if the U.S. rules are more stringent instead of less stringent than international standards?
I find it very strange, especially because most unbiased cost-benefit analyses by independent actors show that those international rules are already less stringent than they should be.
Any other key highlights of the bill that give you concern that this?
Yeah, the fact that it empowers large Wall Street banks to sue regulators to overturn these safety standards. And in a lot of cases, the court would be far less expert on the quantitative analysis of these regulations than the expert regulators in the Federal Reserve.
So we would be going back to conditions pre-recession.
That's right, and we would be empowering foreign countries to govern our regulations.
That's all I need to know. Thank you, and I yield back.
Gentleman yields back. With that, we go to the gentleman from Pennsylvania. Mr. Rothfuss is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Ducharme, one of the things that we often hear about from financial institutions of all sizes is that the costs associated with complying with all of these new regulations have been skyrocketing. As a veteran of the credit union industry and as someone who has grown an institution from less than $100 million to over $540 million, perhaps you can comment on the explicit costs associated with this increased regulatory burden. Taking the MIT Federal Credit Union as an example, how have your compliance costs changed since the financial crisis?
The impact that has been placed on my organization since the financial crisis has been pretty significant. And it's commensurate with our growth in assets as well as the additional regulatory burden that we've incurred with these additional regulations. To quantify that, I think you would look at the personnel that we have created, or departments that we've created, and the personnel that we have had to add in the risk compliance and risk management area of the credit union. We've had to add a number of individuals that have expertise in these areas that we previously did not have to employ.
How many people are we talking about that you've had to add?
Currently in our risk management department, we have a senior vice president that oversees that. She was part of the organization before, but there are 4 individuals that are part of that risk management department that we previously didn't have.
And there's a cost associated with that, correct?
Absolutely, absolutely.
What are the consumer impacts of these higher costs and the increased focus of resources towards compliance activities as opposed to actually working with customers?
I'm sorry.
The consumer impacts of these additional costs that you're experiencing.
So allocating resources for this is prudent, right? And so there are regulatory requirements that we have to ensure that there's sound practices in place. It's the additional burden and the addition of staff that takes away from us to be able to provide those resources to the members that we serve. So
now, your credit union didn't cause the financial crisis, correct?
That's a very good point, Congressman. No, our credit union itself did not. Actually, during the financial crisis, our credit union performed extremely well. Our delinquency rate is 1/3 of the industry. Our loan losses...
Yet you're incurring all these additional costs for something that you really had no role in at all.
That's correct.
Mr. Cimino, I appreciate your comments on the TABS Act. As a co-sponsor of this bill, I understand how important it is to ensure that our prudential regulations are based on sound analysis that take into account market impacts. I'm especially concerned by the practice of gold plating, which I worry puts American firms at a needless disadvantage. Can you describe the impact of past gold plating on U.S. competitiveness and growth?
Yeah, thank you for the question, Congressman. This is a key factor, and again, this bill is going to add transparency to not only identify what that competitive impact is, but provide a rationale if that rule is in fact different. But we see on something as simple as a GSIB surcharge, $52 billion of capital on the sideline. Now, if you were able to invest that in the economy through a normal financial mechanism, you could see up to $287 billion of new lending out there. That is just one example of how this can impact and create economic growth and opportunity through the United States. But I think when you look at the competitive environment more broadly, when you look at rules like the supplemental leverage ratio or the liquidity coverage ratio, you're talking about even different calculations that are going to incentivize different firms to behave differently. And when those calculations come out more beneficially for those not subject to the U.S. regulations, you're inherently hindering how U.S. firms can operate, the types of products and services they can offer, and what they can do to invest in the U.S. economy.
You know, I'm mindful of the research that Stephen Strongen has done, where he estimates that the impact of all the regulation that we've had over the last 8 years, 650,000 fewer small businesses, translating to 6.5 million fewer jobs. That's 6.5 million people not paying Social Security tax, 6.5 million people not paying Medicare tax, 6.5 million people not paying income tax that help us to underwrite the costs of things for education, for veterans benefits, for maintaining a robust defense. I appreciate your comments there. Mr. Chairman, I'm going to yield back the balance of my time.
Gentleman yields back. With that, we go to the gentlelady from New York. Ms. Maloney is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member and panelist. Mr. Cimino, I'd like to ask you about H.R. 3746, the Business of Insurance Regulatory Reform Act. I understand that the goal of this bill is to clarify that the CFPB does not have the authority to regulate insurance companies that are engaged in the business of insurance. But isn't this what Dodd-Frank already says?
We do believe that it is, in fact, trying to clarify what Dodd-Frank already says, and I don't believe that it's a downside to provide more clarity to that. But the reason why I think this bill is necessary is, since the CFPB is established, we've seen a few instances where we've seen it creep into other areas that I don't believe Dodd-Frank intended it to do so. One of those is when it did, in fact, request information on some ancillary products, including things like credit insurance, and that was opening a door to an area that is a clearly state-regulated product. And in another area, we noticed that the arbitration rule would, as proposed, apply to life insurance providers when making policy loans. Again, that is an area where we believe that the state regulatory system is well within the purview of oversight there. So we are trying to clarify that and recodify the intent of what we believed Congress was doing with the Dodd-Frank Title X.
Dr. Stanley, what do you think of this bill? Do you think it curtails the CFPB's authority too much?
Yes, I do. I think the current Dodd-Frank language is clear and well drafted. It states that the CFPB does not have authority over insurance companies except insofar as those insurance companies engage in consumer financial activity that falls under bills that the CFPB is already supposed to enforce. And what this bill would do is it would modify that language to add a very broad and vague proviso that the CFPB could not act in any case where the entity was engaged in the business of insurance. And I think that it's very likely that courts would interpret that to say that the CFPB could not act even if that insurance company was providing a consumer financial product. And what that would do is it would set up a two-tier system where companies could evade CFPB jurisdiction under doing consumer financial activities simply by claiming that they were doing the business of insurance. And my written testimony lays out how that works.
Thank you. I'd like to follow up on a point that the ranking member raised, Dr. Stanley. I want to ask you about H.R. 3179. And the way I read the bill, it would require the banking regulators to conduct a cost-benefit analysis anytime a U.S. rule is more stringent than the international standard, but not when the U.S. rule is less stringent than the international standard. It would also allow the industry to sue the regulators over their cost-benefit analysis, potentially delaying important safety and soundness measures by tying them up in court. So do you think it's fair to require the regulators to conduct a cost-benefit analysis only when the U.S. rule is more stringent than the international standard, but not when it is less stringent? Dr. Stanley,
I don't, and I think the statutory cost-benefit requirements, even if you did require an analysis when it was less stringent, which I think is obviously called for, I think these statutory cost-benefit analysis requirements have big problems because they end up throwing things into court. They empower the big banks to sue to overturn regulatory standards, and then you have non-experts in court making the decision on how strong these standards should be, and often doing it based on industry research financed by industry consultants. And I just wanted to also respond to what Mr. Cimino said about U.S. competitiveness and growth. I think the U.S. banking industry is the most competitive banking industry in the world right now, and the reason for that is that it is well capitalized, it is strongly capitalized, and it is well regulated. I think the European banking industry is much less competitive because it's poorly regulated and people feel that it's poorly capitalized.
I agree. Mr. Cimino, very quickly, can you speak to this issue that we talked about? Why should the regulators be required to conduct a cost-benefit analysis when the U.S. rule is more stringent, but not when it's less stringent? And do you think it's helpful to allow the industry to sue regulators over the cost-benefit analysis? I have 6 seconds yet left.
I think that we're all trying to get at the same intent, and to the extent that we're creating differing standards that would place U.S. firms at a competitive advantage, that is an acute area of focus. But there is an openness to trying to figure out why that delta would exist on either side and making sure that we'd have the appropriate review in place to ensure that we're getting at the appropriate standards at home and abroad here. So I do think that we can work on things like that. As to the litigation area, we see this transparency mechanism an opportunity for greater information, greater clarity, and understanding what that looks like. And that's something subject to a lot of the different regulatory fields, not just this particular function. I'm sorry, I've run out of time, sir.
Gentlelady's time has expired. We recognize the gentleman from Florida, Mr. Posey, for 5 minutes.
Thank you, Mr. Chairman. I'd like to briefly discuss two solutions on the agenda today, briefly. And thank you for holding this hearing. H.R. 2570, the Mortgage Relief Fairness Act, is a common-sense solution that will provide more options for home buyers, particularly low- and middle-income consumers. When consumers purchase a home through a mortgage broker company, they can either pay the fees of the company up front through their own personal bank account or pay the fees over time in the form of higher interest rate from the lender. If the consumer elects the second option, then fees are reflected in the form of a higher interest rate and essentially become cash paid to the mortgage brokers for commission or fees. Many borrowers choose the second option because it enables them to have more capital on hand for home renovations or for other purposes. Unfortunately, the CFPB is currently counting the interest rate and then the fees included in that rate on top of it within the 3% qualified mortgage calculations. Essentially, the CFPB is double counting, and this policy risks taking away a competitive channel that helps consumers obtain financing through multiple sources with just one application process. As a result, the double counting of loan origination fees could have an adverse impact on low and moderate income borrowers by limiting their options to obtain financing. Although the CFPB has acknowledged this is a problem, the Bureau says they are locked into this interpretation because of their interpretation of the current law. The Mortgage Fairness Act will correct this by amending the Truth in Lending Act to prohibit counting any payments that are reflected in the mortgage rate offered by the creditor or lender in the 3% qualified mortgage calculations. I'd also like to address H.R. 4464, the Common Sense Credit Union Capital Relief Act. It would address the National Credit Union Administration's final risk-based capital rule. In January of 2014, the NCUA board initially proposed a risk-based capital system for credit unions. The proposal drew over 2,000 comments, and over 360 members of Congress expressed concerns. Based on those comments and concerns, the NCUA board issued by a 2-to-1 vote a revised risk-based capital proposal in January of 2015. The revised rule establishes a new method for computing NCUA's risk-based requirement that would include a risk-based capital ratio measure for complex credit unions, and that's those defined by rule as any credit union over $100 million in assets. The revised rule drew 2,167 comments, an even higher number of comments than the first public comment period. In addition, NCUA's now Chairman McWaters opposed the rule's implementation in 2015, stating that, in his dissent, he did not believe that the NCUA possesses the legal authority to adopt the rule's two-tier risk-based net worth regulatory standard. And yet, the rule moved forward and was finalized in October 2015, regardless of the many concerns voiced by the industry and the dissent of NCUA's Chairman McWaters. Questions continue to be raised regularly about the cost of this rule on the industry, the legal authority of the agency to implement this rule, and the regulatory burden that this rule will have on credit unions and the impact on credit unions' capital buffers or capital cushions, which could extend into the hundreds of millions of dollars. Remember, we're talking about credit unions owned by members. The rule is a costly solution in search of a problem. And so the Common Sense Credit Union Capital Relief Act offers a simple solution. It would require NCUA's final risk-based capital rule to ensure that we don't unnecessarily burden credit unions and their members. I'm confident this bill will set us on the right track toward a better designed risk-based capital system, a system that won't adversely impact our credit unions, their members, and the important services they provide to our communities. I would just wonder if any of the witnesses would want to comment on what they think would make it easier to comply with the implementation in 2019 and how they think it would affect the business model that we now have. Any comments from anyone?
Any responses from the panel?
Thank you, Congressman Posey. If you look at the risk-based capital rule that's set to be implemented in January of 2019, it really does three things. You talked a little bit about defining complex credit unions. It basically takes this very broad definition and takes 1,200 credit unions and says, you're complex. It doesn't look at the way they conduct business or the risk that they're currently in. It also takes 40 credit unions, and it says that you are downgraded in how you are looked at from this risk-based capital rule. And MIT-FCU is one of them. So with the implementation of this rule, you're now saying that graduates of MIT are now more risky to lend to or to provide services to than you were prior to this rule. Bottom line is that the requirement does three things. First of all, it requires credit union to set capital aside, $1.4 billion in cushion that's going to go away. It's going to take that money out of the lending cycle, and so we're not going to be able to provide services to our members as we have in the past. And therefore, it's going to hurt more than 110 million Americans and members across the country.
Thank you. Thank you, Mr. Chairman.
Okay, the gentleman's time has expired. With that, we go to the gentleman from Georgia. Mr. Scott is recognized for 5 minutes.
Thank you very much, Mr. Chairman. This interesting hearing, very knowledgeable. I want to focus my points on H.R. 3179. And Mr. Semino, correct?
Very good. Yes, sir.
I got it. Let me focus on you for a second. You said, and I quote in your testimony, you said that you felt this would bolster U.S. competitiveness relative to foreign firms. And that's one of the solid good reasons we should be supportive of 3179. And I agree with you. I'm a very determined person on this committee ever since I've been here to make sure that our financial system is #1 in the world. So that registers very well with me. And I think it's also important to note that the bill doesn't touch the baseline internationally agreed upon standards, and that all Mr. Hollingsworth is asking that we do is to take a more serious look at the gold plate standards our regulators are layering on top of the Basel capital standards. Now, where I have a little bit of a wrinkle that I want you to help me out with is in the cost-benefit analysis. Now, I'm a firm believer in cost-benefit analysis because I think it could be very, very productive. But there has been a tendency for oftentimes for the purpose of putting cost-benefit analysis in things is it adds extra burdensome duties. And I think that if the intent of the cost-benefit analysis is to simply clog up the system with hurdles and provide, and you at the Financial Roundtable, and you are aware it has been in the history that oftentimes that's what side benefits or purposes of cost-benefit analysis is. So I want to be clear that we can address this issue in a way that it's not used to clog up the courts or for that sort of thing. The other thing is that I do have a little bit of concern that the cost-benefit analysis could give industry a private right of action. And if a private right of action could be used, has been used, for the purpose of clogging up the system. So I want to ask you, do you think that we could modify this a bit, maybe have some language or amendment added to this bill to help it along its way that could clarify these concerns.
Thank you
Could
for
we
the
do that?
Well, thank you for the question. If I could unpack a few things. First, I do want to go to your first point. This is by no means reopening the Basel Accords, and to Dr. Stanley's point, not making that consensus harder. What we're doing is looking at the U.S. pieces and whether or not they're adding on there. To your point, I think we're sharing that goal, and it's not the intention of this bill to clog up the system or delay things. What it's trying to do is making sure that we're getting, in a transparent manner, the best information possible to inform these rulemakings and understand the rationale beyond that. So it's not our intent to necessarily clog up the system. As
Okay.
to the, yes, sir.
I got on 50 seconds. Dr. Stanley, let me ask you, if I were to offer an amendment to this bill, to the cost-benefit analysis provision that explicitly precluded a private right of action, plus added a requirement that the measure, that we would measure any impact on the safety and soundness of the U.S. financial institutions. Do you think that that could get the Americans for Financial Reform more comfortable, just more comfortable, could help us along the way? We clearly want to make this a bipartisan effort, but I think if we did that, it doesn't hurt what Mr. Sinemo is saying. It's not to clog it up, but this could give us some assurance to do that. Could you go along with that, if we could put that amendment in?
Obviously, we have significant concerns about this bill, but we would be happy to talk to your office because I think that that private right of action, that ability to take it into court, is really a very serious issue, one of our top issues with the bill. So.
Good, and Ms. Zimmer, you could work with us on that?
Yeah, happy to collaborate. I think we're sharing the same goal, so we'll work with your office.
All right, thank you.
Gentleman's time has expired. With that, we recognize the gentleman from Florida, Mr. Ross, for 5 minutes.
Thank you, Chairman, and thank the panel for being here. You know, I think, I'm not speaking on behalf of my colleagues on either side of the aisle, would agree that regulation is good. Regulation is necessary. I mean, we've got to be able to have rules in a game, and those rules have to be able to not only make sure we have competitive markets, but also that we protect our consumers. But to the extent that the regulations become so overly burdensome and cost prohibitive, that we start seeing a presumption by the regulators that the financial service provider is really there for unjust enrichment and undue influence over its customers. When in fact, as I look at your industries, with the exception of Dr. Stanley, I understand and firmly believe that the sustainability of success in your particular industry is completely dependent upon the satisfaction and success of your clients, which in and of itself is a regulatory scheme that has worked for years, called the private enterprise, the markets. And so my concern is to what point do we finally say, wait a second, what is this regulator's goal, and what presumptions have we given them that put such a burden on our consumers that we're hurting our consumers in the name of consumer protection? And Mr. George, to your point, with regard to the ability to repay rule and qualified mortgage standards, the doubling of points and fees, I mean, what does that lead to? I mean, that leads to a loophole of a scheme that works not to the advantage of the consumer, but to the advantage of that financial service provider who can take the best advantage of it, contrary to what I think our regulators want to see.
Well, thank you, Congressman, for the comment. My response will be that a couple of things. Those of you in the room that have purchased a home before, you understand that the process is fraught with a fair amount of anxiety. There's a lot of uncertainty that goes through the process. What we're trying to do, this isn't about disclosure. It's not about compensation. Dr. Stanley did a very good job.
It's about assessment of risk, a risk that you choose to bear. Go ahead.
It's really about a fairness component. If you have a broker and a retail loan officer both disclose a loan, both of those loans will come out with the same number at the bottom, the same cost at the bottom, except the broker loan will be subject to a calculation that could disqualify the loan simply the way we calculate the points and fees. That's it. That borrower would have to start over with someone else. And a large amount of our business is about trust. It's about understanding that the person is working on your best behalf, but it is not about further compensation. Yield spread premium today does not yield a single penny to a loan officer, regardless of where they sell it. And to your point about regulations, loan costs have nearly doubled in the last 12 years that I've been in this business. I've been doing it now for 35 years. It is largely based on the regulatory oversight. I'm not saying get rid of all of the regulations. There's a lot of good ones. I'm saying to you the ones that are unnecessary, redundant, that stifle innovation, we need to look at those.
And how does that impact the challenges that we have for affordable housing today?
Oh, it's a huge impact because as loans are smaller
A huge
loans,
negative impact.
it has a much bigger impact on smaller loans because you're trying to spread that dollar over a smaller dollar.
And we're hurting more than we're ever trying to help because of it.
It's
Mr.
the low to
Cimino,
moderate income people that suffer the most.
I agree. Mr. Cimino, you know, absent a private right to sue, how in the world do we hold accountable these regulators?
Well, I do think that that's what this is trying to get out to.
Really, a sense of due process?
Yeah,
to say we challenge what you're doing and saying, you know, you didn't apply a cost-benefit analysis, and suddenly we that are probably the judicial model of all other nations in this country say, oh, by the way, we're not going to give you a private right of action to sue because we're not going to want to hold you accountable? Why is that such a big issue?
I wouldn't want to speak for folks that are very concerned with it, but I do think that it's applied in all other areas, and relinquishing that right in this particular area is something we'd have to discuss as to what the implications are. But when we're talking about transparency, we're trying to get to better outcomes here, and to the point of accountability.
And
I think
all I'm
we've hit
trying
on
to do
that.
is hold our regulators' feet to the fire to make sure they do what they're supposed to do without overreaching. And one last quick question. The CFPB, they have no business in the business of insurance, and Dodd-Frank suggests that, but that HR, what was it, 3746 confirms that.
That's correct, sir. We're
What's
recodifying
wrong
your
with doing
intention.
that? You said in your statements, McCarran-Ferguson is probably the best thing that's happened. Dr. Stanley, you said we have the best system of insurance regulation in the world, and I agree with that. It's a state-based. It's a risk-based capital system. Let's just confirm that and make sure that there is no mission creep from the CFPB, and I see my time's up.
Gentleman's time has expired. With that, we go to the gentleman from Washington. Mr. Heck is recognized for 5 minutes.
Thank you, Mr. Chairman. Excuse me. Mr. George, I want to start with you, ask you a question that is frankly off topic, but I never want to miss this opportunity. And I was given the perfect setup by my predecessor questions. I'm going to give you a fact pattern and then ask you to answer a question. Last year was the best construction year for home building we've had in this country in a decade, and yet it was still only at the level of 1994. Indeed, the home building industry is a third smaller than it was in 2005, but our number of households is growing even faster than it was in that year. The estimates that I've seen, and I'm sure you've seen, are that we're building millions fewer units than we need, and we all know what that results in. Young people living together, doubling up, tripling up, or living in mom and dad's basement. Trust me, I know this story well. Home prices are soaring, rents are soaring, and those are the lucky ones that get to do that. Because the truth is, when you have this picture, you inarguably, inevitably create more homeless people. It is a natural law and consequence. So, without respect to the bills before us, you're in the business. Why aren't we building more homes?
Whew, okay. Well, let's just start about that. I'm not a home builder. I certainly do represent a whole bunch of them. But I can tell you that a number of things are happening. First of all, I think that a lot of people blame it on the federal government. I actually think there's a lot of state statute that puts a lot of additional expense into home building today. It's hard to break ground on a piece of property and make a decent return on that given the oversight and regulatory burden that happens locally. The second thing is that I would say to you that it's hard to find skilled labor. We aren't doing a very good job in this country in training people how to be electricians, plumbers, framers, roofers, et cetera. I know that personally, particularly right now. There's a glut of that labor in the state of California. Last but not least, I think it's incumbent upon us as a lending industry to become a little more innovative in the way we look at loans. Let me give you a quick example. Generally speaking, the number one impediment for somebody buying a first-time home is their down payment. Particularly today, it's hard to raise money with student debt that they have as an overhang from going to school, or even for that matter, when you see rental being 40, 50, 60% of somebody's income, you're almost always going to not be able to save a couple of bucks at the end of the day to be able to put a down payment. There is innovation in the marketplace recently introduced that is talking about having a broader way that people can gift money to people, not borrow money, but gift money. So it forms itself in a crowdfunding environment so that millennials today are thinking more of different ways to be able to come up with their down payment. Fannie and Freddie are both looking at the way loans can operate. Two identical borrowers, one with no down payment but 2 years worth of reserves, one with a minimal down payment and 2 months worth of reserves. Both of the agencies are seeing that having a deeper level of reserves protects them against a default than what we saw previously. I also think that we're doing a far better job servicing loans. Previously, prior to the housing crisis, a loan could go 30, 60, 90, or 120 days delinquent well before anyone reached out to the borrower to talk to them about solutions. That whole process is wildly different. You get a single point of contact. We're reaching out to you aggressively, trying to figure out what's going on. And in many cases, we're modifying your loan so that you don't go that far behind. Answering your question as it relates to builders, I do think that there's a number of things impeding this, and so the move-up customer moving from their starter home today isn't moving up, and I think that's leaving inventory really strangled, particularly in parts of California and all throughout the United States.
Mr. George, for somebody that answered a question that wasn't on your agenda today, I thought you did an outstanding job and that you were comprehensive, and I express my appreciation to you.
With my last name, George, it's almost incumbent upon me to be curious, so thanks for the remark.
I want to conclude with two observations that I've come to in my year's work on this. The first of which is this is a bigger crisis in this country than we're acknowledging, i.e. not building homes at sufficient pace to keep up with demand. And the second is it's an ecosystem, and everything we do in one part affects another. You made reference to the GSEs. There's kind of underlying consensus in this environment that GSE reform will allow for more upfront risk capital. Inevitably, that will ratchet up the number of basis points of a cost of a mortgage. Inevitably, that will make more homes out of reach for people. And so my final point would be whatever we do in the way of GSE reform and housing reform, we have to remember it's an ecosystem. Every piece affects the rest of it. Thank you very much for your excellent answer.
Gentleman's time has expired. With that, we recognize the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. Dr. Stanley, if you were to give a grade to former Vice Chair of Supervision at the Fed, Daniel Tarullo, what grade would you have given him in terms of financial regulation?
I'd say I'd give him a solid grade, a B or a B+. There are some areas where we disagreed with him, but I think he drove through rules to completion, and that was positive. And frankly, I agree with the fact that he did so-called gold plate the Basel rules. I think that was actually a wise move. So.
What do you think about his parting comments, his parting observations as he departed from the Federal Reserve when he said that the new capital requirements have impinged on market liquidity?
Excuse me?
What do you make of former Vice Chair of Supervision Tarullo's comment in his waning days in his position when he said that upon reflection, that the new capital requirements impinged on market liquidity?
Impinged on market liquidity. Well, frankly, that parting speech was one reason I downgraded him into the Bs, because I felt that he sort of undercut some of the advances he had made. But I really feel that the capital markets, if you look at the capital markets, we've set records in bond issuance each of the last 5 years.
Well, let me ask you this. Do you agree with with Mr. Tarullo when he conceded that local or community banks should not be subject to the same Dodd-Frank requirements as big banks?
Well, I think that I do agree with that, and I think they already are not subject to the same Dodd-Frank requirements as the big banks. I feel the Fed has scaled the rules.
Mr. Cimino, is there any reason to believe that international standards are deficient in terms of prudential regulation?
The international standards themselves?
The international standards.
We don't necessarily have data or examples of that at this stage. No.
Yeah, so I mean, the point would be that with Basel and with all of the other international rules relating to safety and soundness, my question is there any reason why gold plating would be required given some of the stringent standards that international bodies have recommended for banks?
I don't necessarily believe there to be, but I guess what we're asking for is let's examine that. If there is a delta, it should stand up to scrutiny and transparent input here. So if the affirmative decision is that there should be by regulators, there should be a rationale behind it. Now, different people and smart people can disagree on that, but I think to your point, we've not seen a deficiency in the international standards themselves, much less a rationale as to why you need to gold plate those standards.
So this is the next question is for Mr. Cimino and maybe Mr. Ducharme as well, to the extent that your institution does do any small business lending, and I know some credit unions do some of that and some don't. But my question would be, Dr. Stanley's testimony, and I've heard many of our colleagues on the other side of the aisle talk about the health in C&I lending, and that lending is up under Dodd-Frank. And yet small business lending volume is way down. Mm-hmm. And that's Harvard Business School study, and regulatory burdens clearly are impeding banks in their ability to participate in small business lending markets. So is that your observation as well? And is that attributable to regulation, over-regulation, Dodd-Frank?
I think there's probably a number of factors, but one clear factor is, of course, regulation. And I do think that you're seeing that the misapplication of regulation can drive a wedge in between the access to credit or the cost of credit from large borrowers, whether that happens to be an affluent consumer or a large business, versus the small borrowers or a lower moderate income borrower. And that's going to create a delta that over time is going to have big ramifications.
And so this is I think one of the deficiencies in with all respect, Dr. Stanley's analysis, because in Kentucky, where we're served mostly by small community rural banks and credit unions, they're disappearing. We've lost 1 in 5 community banks. Small business lending comes from community banks and credit unions. So this idea that lending is strong in the aftermath of Dodd-Frank and that Dodd-Frank actually did tailor regulations, well, that defies the evidence, the record. The record is that 1 in 5 community financial institutions in rural America has disappeared. And that's why small business lending is down. So this analysis that commercial industrial loans are up does not account for the reality that entrepreneurship is at a 20-year low because community banks have disappeared because of overregulation. And in the remaining time, Mr. Ducharme, would you like to comment on that?
Thank you, Congressman. You are correct in your statement that there are some credit unions that are in small business and business lending. My credit union is not one of them.
Okay, thank you. I yield back.
Gentleman yields back. That we go to the gentleman from Colorado. Mr. Tipton is recognized for 5 minutes.
Thank you, Mr. Chairman. Apologize for being late, gentlemen. Appreciate you taking time today. I want to get this. Ducharme, is that, how do you pronounce that? I want to get that correct. Ducharme, correct?
Ducharme, Congressman.
Would you possibly speak to the impact that you think that the tailoring process through Agrippa would have on your industry?
One of the benefits that it would have is threefold. First of all, although NCUA volunteers to be part of the process, it would now, regulatory-wise, statutory-wise, place them in it. It would also include the CFPB. Primarily, as we see it, it would require the institutions identified in the legislation to review all rules and regulations every 5 years. And that would certainly lead to the review and possibly the relief of regulatory burdens of unnecessary rules and regulations that are placed on financial institutions.
Yeah, I'd like to be able to kind of get your view looking back just a little bit. Had regulations been appropriately tailored, do you think that fewer credit unions would have closed after the financial crisis and the passage of Dodd-Frank? Have we had those regulations tailored?
And again, this is just my opinion. Clearly, the number of credit unions, smaller credit unions that have closed in the last 5 to 7 years have been because of the excessive regulatory burden that has been placed on them, Dodd-Frank being one of those.
So that tailoring would help. Mr. George, do you have anything maybe you'd like to add to that?
Yeah, I mean, my comment about it is that I'm not a fan of throwing out every single regulation. I just think that we ought to revisit some of the ones that are overburdensome and unnecessary. And I'm not trying to say that they are going to be changing congressional mandated regulations. I'm talking about regulations that the regulator could take a look at and say, these particular regulations are stifling innovation, they're stifling growth. Keep in mind that, yes, some of the companies that are up here and have been up here before are big companies, and they can absorb that kind of expense associated with regulatory oversight. But the vast majority of this industry is largely small businesses that operate in the communities that best need them, best are suited for them. The low to moderate communities, the people of color, the folks that are the first-time home buyers that are having trouble thinking through the process, those organizations work tightly with housing counseling organizations and help people usher them responsibly into home ownership. I think if you overburden them with things that are not productive or not useful, I think it's defeating the purpose, right? It's working against us.
Great, thank you. Mr. Cimino, you stated in your testimony that between the first quarter of 2009 and the end of 2016, common equity capital ratios at our largest banks climbed from 5.5 to 12.5%, representing a new capital cushion over $750 billion. And you went on to say that the globally systemic important banks are subject to a Method 2 methodology for capital surcharge, which in some cases produced an extra 2% capital charge in addition to the international standard, and has reduced the lending capacity of the U.S. financial system by $287 billion. Mr. Cimino, in the aforementioned capital figures, had they been subject to internationally agreed upon standards instead of the gold-plating regulatory regime imposed by the federal prudential regulators, do you believe that the U.S. would have had a stronger economic recovery?
I think you've hit it on the head. The U.S. financial system has undergone a substantial recovery. They're strong, they're well capitalized, they're resilient, and we've not necessarily seen economic growth translate. We want to get more investment into the economy, and when you look at that GSIB surcharge, I think we're talking about approximately $52 billion sitting on the sidelines based on the delta between the internationally agreed to standards and what U.S. regulators have applied to. When you go through that financial mechanism, putting that $52 billion into the economy, potentially $287 billion of investment in people, investment in businesses, investment in communities. And that's where we're really going to see that economic growth drive forward and that economic opportunity available to more and more Americans.
Great. You know, we're in the process right now of trying to be able to deal with the tax code to be able to make us more competitive. It's equally important to make sure that we have a regulatory policy that keeps that competitive edge for us as well.
Very true, sir.
Thank you. Mr. Chairman, I yield back.
Gentleman yields back. With that, we'll go to the gentleman from Texas. Mr. Williams is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for the witnesses being here today, which is good dialogue, and we appreciate you being here. Mr. George, first of all, thank you for bringing up the lack of welders, plumbers, and so forth. I talk about that all the time, and we need it, so thank you for reminding us. In your testimony, you offer a lengthy discussion about your support of the Comprehensive Regulatory Review Act. I, too, feel that the CRA2 is an important piece of legislation that will lead to better regulatory policy. Our agency should strive to create policies which are effective and necessary, and timely review of EGR-PRA review like what is called for in the CRA will help to ensure that. So my question to you would be, you mentioned in your testimony that the faster review period will help regulations keep pace with the market and do not stifle technical innovation. So how does the current EGR-PRA review timeline stifle technological innovation?
Most certainly, and listen, there's been not a whole lot of innovation in our industry over the last 10 years. I think that that's for a variety of reasons. Some of it that has come out has really helped a consumer and also helped lending overall. We're much more precise in the way we do things today. So what I mean by that is that today we verify everything. So everything that comes through our loan package is not left subject to either a document that's provided. There's independent verification of your income, your assets, your credit, your history, your employment, your evaluation, everything. And we've done that through technology to speed that process up. Previously, it was a much more manual process. Number two, as I mentioned earlier, since there's such a hindrance of folks being able to come up with a down payment, we're starting to think differently about down payment. We're starting to think differently how people can come up with their down payment and how we can make that process simpler, not because we're trying to get people who do not qualify into a mortgage, but what we're trying to do is get people who qualify into a mortgage beyond the minimum required to get into the mortgage. Clearly, a person who puts down 3% versus 30% is going to have a lot bigger buffer to weather a storm if there's a downturn in value. What we think, though, is that there's a reluctance to innovate. And the reluctance to innovate is largely based on, if I create this new process, product, or procedure, am I suddenly going to be attacked from a regulator because it is something different? Forget about the headline risk. What we're simply trying to do is put together a set of rules and make sure that we are not using outdated or useless rules that stifle that kind of innovation.
Okay, another question for you. I'd like to talk a little bit about the CFPB. We talk about that a lot. Aspect of the CRA. Since its inception, the CFPB has finalized over 60 rules and changed several more. Now, I believe that this agency has done nothing good, absolutely nothing, and that we should do all we can to lessen its harmful impact on American consumers and businesses. And specifically, I'm glad to see the provision in the CRA that would require the CFPB to be included in the EGRPRA reviews. So under this proposal, CFPB can't pick and choose which rules it will review and which it won't. So given this, can you elaborate on whether or not the CFPB under this proposal would be able to react to the market changes and technological innovations you mentioned in your testimony?
I believe they can. And listen, I think that if you sometimes I think that the CFPB is focused on a particular rule or regulation when that particular rule or regulation isn't germane or important to what is necessary for oversight. I think that the CFPB does have the ability to be able to review and regulate this entire process. I also think that, and I mentioned this once before, there have been a whole bunch of rules and regulations that I think have actually been helpful for this industry. There was, back in the day, just about anybody could get in. It was a little bit of the Wild West back then, and nowadays it's much more pragmatic. This is what I've done my entire life. I've been in this since I was 19 years old. I'm very proud of what we have done and the customers that we have reached. And I think today, with some refining, I think we can reduce some of that regulatory that burden and also reduce some of that expense, which, by the way, I think reduces expense to borrowers.
Thank you. Real quick, Mr. Ducharme, credit unions, I believe, are essential to Main Street America. I'm a Main Street borrower. It's important that we do all we can to make sure that they are not overburdened by regulation. We've talked about that. In your testimony, you briefly touch on H.R. 3746, which would clarify the limits of the CFPB in regulating insurance. So can you elaborate more on how the CFPB's regulation affects a credit union and the concerns that you have with this jurisdiction creep that we've got?
Thank you, Congressman. Well, I can tell you how it applies to my credit union. So we have about 15,000 individuals that work in the MIT community, and a number of them appreciate the value of credit protection products in that it really provides them a benefit if there is a life event that they may unfortunately go through. If you look at life insurance, those products, it's currently regulated by the Commonwealth of Massachusetts, in my case, at the state level. If it, I think the CFPB would find itself in that area.
Gentleman's time has expired. That would go to the gentleman from Michigan, Mr. Trott. He's recognized for 5 minutes.
Thank you, Chairman. I also want to thank everyone on the panel for your time this afternoon. Dr. Stanley, let's start with you. So you obviously haven't met or seen a regulator or a regulation that you don't love. So let's talk about one of the regulators you've mentioned a couple times today, the CFPB. And specifically, let's talk about the PHH case. Are you familiar with that case?
You know, I have to, I'm not our main person on the CFPB.
Right, let me give you a couple facts and just get your off-the-cuff opinion on the good work of the regulators in that case. So PHH was accused of some Section 8 RESPA violations. HUD imposed a penalty, I believe, of $8 million. The then czar swooped in on behalf of the CFPB and said the statute of limitations isn't relevant. The HUD review and findings are irrelevant. There is no due process, and the penalty is $109 million. Does that seem like a fair result for business, or does that not bother you? Because again, we're talking about a bank, and all banks are bad. Is that, you know, what's your thought on the fairness of that scenario? Because those are the facts, and the Court of Appeals agreed with my analysis, but that it's not fair. What are your thoughts?
You know, I'm not trying to dodge the question, but I just genuinely just don't know the background.
All right. Okay, that's fair enough. So let's move on to something you mentioned in your testimony then, and I want to ask Mr. George this question. What's the fee if the borrower chose not to roll the brokerage fee into the interest rate? You know, Dr. Stanley said 25 basis points might increase the interest rate. What's the fee on a $300,000 loan?
I'm excused. On how much of a loan? Thank you for the question. What was on how much of a loan?
Well, Dr. Stanley in his example said that on a $300,000 30-year mortgage, it could end up costing the borrower an extra $16,000. What's the fee if they decide to pay it at closing?
I don't understand where that statistic comes from.
Right.
I suspect you know that we have a pretty competitive marketplace,
right.
And that competitive marketplace is much simpler today for a consumer to shop a price. You know that.
Right.
Today you can get online and you can look at 50 different lenders with the push of a button. There are systems in place for people to compete for those loans. So I don't understand the quarter point cost. I think it was, I would guess that it's just a relative number on any loan. If you charge an extra quarter, it would be an additional X amount of dollars over 30 years.
Well, hypothetically, if the fee is $500 at closing, the future value of that money over 30 years is $10,000 almost. So a little misleading in the example insofar as, you know, you can pay now and use your capital now at closing to accomplish the dream of home ownership, or you can roll it into the fee. You know, I think the arguments made by Dr. Stanley with respect to the impact it has on low and moderate income folks is completely wrong, and I think your point was spot on. You know, you made a comment about the cost of closings doubling over the last 10 to 12 years, and I think that's the most telling comment, and a lot of what we're focused on today, in my opinion, you know, Washington and Congress and the regulators, I spent many years in the mortgage banking industry, have it all wrong. They should be focused on trying to simplify the rules and make the cost of obtaining and originating a loan as least expensive as possible. And we've done everything the exact opposite. We've made it so complex the borrower doesn't know what they're signing at closing, and they've doubled the cost of loans. Last question, and then I'll yield back. Dr. Stanley, with respect to the Regulatory Review Act proposed by Mr. Loudermilk from Georgia, you oppose that. Do you think Dodd-Frank is perfect?
No, I don't think Dodd-Frank is perfect,
and
we
have some unintended
sorry.
consequences that maybe Congress didn't anticipate when they wrote Dodd-Frank, or some unintended consequences from that law?
Well, I think Dodd-Frank was a compromise, like many things that come out of Congress, and in some ways I think that that Dodd-Frank didn't go far enough in some areas, such as eliminating too big to fail banks and so on.
But so you oppose the Review Act every 5 to 7 years. Why? Wouldn't it be a good idea to see if any of the regulations are working as intended, or maybe outdated, or should be revised or tailored to suit current business practices?
Well, we have a Review Act right now that requires review every 10 years and the regulators to get rid of unnecessary regulations, and I think that's very straightforward and clear, and a lot of the language added here would focus exclusively on the costs to businesses and not the benefits to customers or the economy, and I feel that language is unbalanced.
Well, we probably fundamentally disagree on the impact on cost of business and who bears the brunt of that cost. But I appreciate your time, and I yield back.
Gentleman, time has expired. With that, we go to the gentleman from Georgia. Mr. Loudermilk is recognized for 5 minutes.
Well, thank you, Mr. Chairman, and I appreciate the comments from my colleague, Mr. Trott, on the Comprehensive Regulatory Review Act. And let me also start off by thanking my colleagues on the other side of the aisle who've been working very closely with us to make this a bipartisan bill. I think they realize that government often doesn't get it right the first time, and it takes a lot of work to get it right over time. And it's an ever-evolving process. I remember my daughter was doing a presentation years ago, and I was in the state legislature, and she said, "Dad, I want to do a presentation on leadership." And so she said, "I've decided to focus on the importance of continuing to lead, not just establishing a rule or regulation once, but continue to work on it." And so she did this presentation, and she brought up several outdated laws, even in the state of Georgia. One of them I particularly remember was, and just so anyone visiting Georgia realizes this, it is illegal to walk down the street with an ice cream cone in your back pocket. It was actually a law on the books in the state of Georgia. That prompted me to go back and start looking at some of the laws we had on the book. And I remember I was in the technology industry, and we found out that some of the telecommunications companies were still having to submit reports on their Morse code stations and teletypes. And there weren't any. And so we started looking at why were they putting that report in. They said because it's still on the books as a requirement, but the regulators have never gone back and reviewed it and took that off. And we talked to the regulators, say, why? I said, look, we're too busy doing our regulation to go and do this. So we passed legislation to remove it. Now, in 1996, Congress, I think, took a pretty good step, Mr. Chairman. They passed the Economic Growth and Regulatory Paperwork Reduction Act, which basically said, look, every 10 years you need to go and review your regulations, and if there's any duplicative regulations or those that are outdated, you need to report those back to Congress. But we really just lacked a little bit of teeth in there saying you really need to do more than just check the box. You need to look at the regulations, and let's get rid of those regulations that are duplicative. Let's not force people to report on things that they're not doing. And let's take it a step further, and this is what we're doing, and the regulation is just saying, let's broaden that to all these financial regulators. Let's include the CFPB, and let's also give them the opportunity to tailor regulations instead of painting with a broad brush. I think that's a pretty reasonable way of doing business. I think that's a very effective way of doing business, that we can let the regulators focus on regulating in the areas that are important and imperative, and not just regulate based on an arcane regulation that happens to be in the book that no one's taking the time to review. So, Mr. George, can you briefly explain, why Agrippa really provides a good basis for cleaning up these duplicative regulations, but from what I've heard, I assume that you would like to see it strengthened. What do you think is positive, and why we should strengthen it?
But I couldn't agree with you more. Listen, think about this. In 2006 versus 2016, the lending environment is wildly different. We're on a different planet. In 2006, CFPB didn't exist, TRID didn't exist, HVCC didn't exist, LO-Comp, Dodd-Frank, all of those rules did not exist. If we are going to say we're going to wait another 10 years to look at a change, I think that really harms our industry. I think that we're far better off taking a look at this on a 5-year period of time, to be able to see whether or not we have accidentally created a rule that stifles either innovation or competition, which is what we're trying to fix with 2570. In my opinion, when you're talking about brokers and lenders that are side by side, two offices next to one another, and the broker loses a transaction simply because his loan is calculated different, not disclosed different, just calculated different, those are the kinds of things that we have to revisit and look at. I'm not, Congressman Trott said something. He said it's, the things of price and oversight of regulation are true, but let me tell you something. What keeps this industry honest is competition. You put more players in this thing, they're going to compete hard to get that transaction. It's hard.
And I appreciate that. And Mr. Chairman, the American Bankers Association agree with Mr. George and myself in a letter that they have provided in support of the Comprehensive Regulatory Review Act. And I'd like to submit that for the official record. if that's possible.
Without objection.
Well, thank you. New voice in the chair there. And I think this is, and I know there are people out there that's never met a regulation that they didn't like. But if you really drill down to the regulators, they, just like the business, are looking at stability. I think we're putting them in the driver's seat to lead their own house.
Will the gentleman yield? Will the gentleman yield?
Well, I'm out of time.
I was just wondering if there was ever a point in time when
the gentleman's time has expired. If
it was a problem that the people of Georgia were walking down the street with an ice cream cone in their back pocket.
If the gentleman yield, I imagine that there was a reason, but around the same time, it was illegal to walk an elephant down the city streets in the middle of the day. So go figure.
Gentleman yields back. The chair now recognizes the gentlelady from New York, Ms. Tenney, for 5 minutes.
Thank you, Mr. Chairman, and I just want to commend my colleague, Mr. Hollingsworth, on H.R. 3179, the Transparency and Accountability for Business Standards Act, of which I'm a co-sponsor, but also I know a lot of people who don't like regulation, who haven't met a regulation they don't like, but can you imagine our own federal regulators working against the interests of our U.S.-based banks and affecting our business community and our competitive nature? I'd like to yield back my time to the gentleman from Indiana, Mr. Hollingsworth.
Well, I thank my colleague, Ms. Tenney, and appreciate her kind words. Dr. Stanley, my first question is for you. I know that there's been some banter here this afternoon, but something you wrote in your testimony really struck me in a positive way. You said the following: H.R. 3179 would impose additional administrative barriers to action on federal banking agencies in cases where they wish to issue prudential regulations. And what I think you mean by that is we need to be really, really thoughtful and really, really serious and go through a real diligent process before we restrict the freedom of our U.S. regulators to be able to take the actions that they think are necessary. And we owe it to them to be thoughtful and diligent in that process, right?
Well, it depends specifically on the barriers, but yeah, I think we need to be thoughtful. Yeah, I mean, I guess I would agree with that.
Yeah, I mean, we need to be thoughtful and diligent, go through a real process. The question I have for you is exactly how we're doing this, right? The way that we have guidelines to regulators is we go through an open and transparent process. Right here, we're having a legislative hearing today about things like that. I think the American people are owed the exact same thing from their regulators. When costs are imposed upon the American people, when companies' freedoms are restricted by regulators, they should be owed the same diligent, thoughtful, transparent process. And they should know what that cost-benefit looks like. That is what I think the American people are owed. I think we do the same thing here when we impose additional burdens on those regulatory agencies. And so when I think about the bill that I have filed and my colleagues have been in support of, the Transparency and Accountability for Business Standards Act, that's how I think about it. I think it is demanding transparency and accountability from regulators because ultimately those regulations that may be in excess, that are in excess of international standards, are imposing costs on Americans. And those costs are real. And here, sometimes we talk about it like the baseline is zero, and any loan growth greater than zero is suddenly okay. But the reality is, according to National Bureau of Economic Research, that over the period since prior recessions and the 6 years following recessions, throughout the previous century, loan growth on average was 63%. Since 2009, loan growth has been 18%. That difference is the difference between real economic growth that lifts wages for Hoosiers back home in Indiana and mediocre economic growth that has led to stagnant wages. I want to unlock some of that capital so that people can get the capital they need to start businesses, so that people can get the capital they need to grow businesses, so we can empower Hoosiers and Americans across this country to be able to take control of their financial future again. And I wanted to direct my next question to Mr. Cimino and just talk a little bit about, there are two pieces to this, but the first big piece is the capital that's trapped in U.S. financial institutions that we need to unlock to enable and empower economic growth, and I wanted to see if you had a comment on that.
Yeah, I think you hit it on the head, and Mr. Tipton spoke about it as well. This is an in and of itself of translating into economic growth. That's what the financial system does when it's thriving. It's investing in communities, people, and businesses. And when you've got $52 billion sitting on the sideline because of a GSIB surcharge, or $75 billion sitting on the sideline because of a supplemental leverage ratio that's applied on an enhanced basis, that's capital that in and of itself is not out there, but also is not being leveraged through loans at an even higher rate and driving that economic growth and opportunity.
That's exactly right. Now, the second big piece to this, right, is ensuring that our U.S. institutions have the opportunity to compete around the world, right? And that is really, really important because financial services is something the United States has done exceptionally well, and we export that abroad to the benefit of, frankly, many other economies, many market economies, many countries around the world. I want to make sure that we still have the opportunity to do that, and we aren't putting our U.S. banks and financial institutions at a disadvantage to that. Can you speak a little bit to that?
Yeah, I think that's absolutely right. Actually, if I could just go back to a quick point earlier, you talked about that transparency and accountability being owed to the taxpayers, being owed to the businesses. I not only think that's right, but that transparency and accountability gets to better public policy outcomes. So when you talk about that and how it leads to a competitiveness issue, if you are applying more stringent standards that don't have a benefit but are just applied and misapplied, all of a sudden you're tying the hands behind the back of many institutions. These are the institutions that are not only helping drive American growth, but they're supporting companies that are performing cross-border services in a global footprint. I mean, everybody from Ford and Chevron to General Electric and General Mills.
I love that. Hold on just one second. The gentlelady's time has expired. The gentlelady yields back. The chair now recognizes himself for 5 minutes. Please continue,
So,
Mr.
gotta love parliamentary procedure. But yes, so not only are you putting a competitive disadvantage in place, but we're talking about companies that do operate across global barriers to help support businesses, drive economic growth. And so when you've got, Ford and General Electric out there trying to operate, it's these large service providers that can help them do so, and we don't want to limit their ability to compete and have that business go to foreign institutions that might not be able to do as well by these U.S. institutions.
Right, so when I'm thinking about this, what I'm asking myself is, why shouldn't we have the transparency and accountability to the American people? Because ultimately these burdens, and we may, frankly, through this cost-benefit analysis and this comprehensive view, determine that U.S. institutions should be held to a stricter standard than international standards, which this certainly doesn't prevent if that is borne out in that cost-benefit analysis. Why aren't the American people owed the transparency from their regulators to ensure that their interests are being protected, their interests are being weighed in every single regulation that exceeds international standard?
Well, we think they are owed that. And again, I think a more inclusive and transparent approach ultimately yields a better outcome. And if that outcome is in fact a difference between the international and U.S. standard, well, there should be a rationale behind it. And we're not necessarily saying these rules are wrong. We're just saying that they deserve that level of scrutiny.
That's exactly right. And one of the other things that's been brought up a lot today is this private right of action business. And believe you me, I am no attorney. I'm an old business guy. But what I understand is that currently the Administrative Procedures Act has a base requirement of a cost-benefit analysis for every rule that's promulgated. This has required a much more detailed cost-benefit analysis. I get that. But there is no giving of a further private right of action than is already afforded to U.S. citizens and companies. I want to make sure that we're clear that we are requiring more transparency and accountability, because what I hear back home, Hoosiers are tired of bureaucrats in D.C. determining their future instead of them being able to determine their own future. They want to take back some of that power so they can build better futures for their families. And while sometimes in this committee we do work that is really arcane, esoteric, and seems far removed from something that really matters to Hoosiers, this is not that. This is something that makes a meaningful difference. This has two big effects again. One, unlocking the capital for our U.S. financial institutions to be able to make loans, to be able to provide capital, to be able to help people get ahead in their lives. And then two, ensure that what we do well in the United States, we can export around the world so that we benefit from the innovations, the hard work, and the diligence of Americans all the way across this country. And so I obviously strongly support the bill. In addition to that, I wanted to submit for the record for a Chamber of Commerce letter of support for the bill as well. Well, I guess since I'm the chairman, I can say. And with that, I will yield back my time. And I'd like to thank our witnesses for their testimony today. I appreciate everybody coming out today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is now adjourned.